You know, if you've been around value investing for even 5 minutes, you've heard the phrase long-term hold. But let's be honest, for a lot of people, this has turned into a huge misunderstanding. This idea that you just buy a stock and then, I don't know, forget the password to your brokerage account. But if that were really the case, we'd have some pretty big questions to answer. And it all starts with quotes just like this one, right from Warren Buffett himself. This is the cornerstone of that whole buy and hold forever idea. And on the surface, yeah, it seems simple. Find a fantastic company and just stick with it. But like most things with Buffett, there's a whole lot more going on just beneath the surface. And here it is. This is the million-dollar question that just throws a wrench into that whole simple interpretation. If the rule is to hold on for dear life, why on earth did Berkshire Hathaway dump its entire stake in the big U.S. airlines back in 2020 and take a pretty big loss on it too? This contradiction is exactly what we're going to unpack today. To really get inside Buffett's head, we need to throw out that old idea of a portfolio as some kind of static treasure chest. We need a much better metaphor. So, from now on, let's start thinking of your portfolio as a living, breathing garden. Think about it. A treasure chest is something you just lock up and forget about. But a garden needs constant attention. It needs care. You are the gardener, and your job isn't just to plant the seeds, it's to nurture them, to cultivate, and to make the tough decisions to make sure the entire garden is healthy and thriving. Long-term hold is for the healthy trees, not the whole plot of land, no matter what. So what does a good gardener actually do? Well, it really boils down to three main things. First, they have to uproot the plants that are sick or dying before they cause more problems. Second, if the garden's getting full, they make space for new, more promising seeds to grow. And third, they've got to prune those trees that have grown so big they've become a risk. Just keep these three actions in your head, because they are the perfect framework for Buffett's selling strategy. Okay, so let's see exactly how these gardening actions create the rule book for when Buffett sells. And spoiler alert, this has nothing to do with panicking about the market. It's a logical, disciplined system. Principle number 1 is really about being honest and admitting, you know what, I was wrong. This is when the fundamental reason you bought the company in the first place has just completely vanished, or it's been permanently damaged. This is your sick plant. The only logical thing to do is to pull it out of the ground. And the airline sale is the perfect example of this. See, Buffett bought in because he thought they were solid businesses with stable cash flow. But then the pandemic hit, and suddenly the entire future of business travel looked completely different, maybe permanently. His original investment thesis was broken. And here's the key. When the facts change, you sell. Period. It doesn't matter if you take a loss. Remember, the stock doesn't know you own it. It's not going to go up just to make you feel better. Now, this second principle is a little bit trickier for people to get their heads around because it involves selling a perfectly good company. It's all about opportunity cost. Back in your garden, if all your space is taken up, but you find a seed for a far superior plant, you have a choice to make. You have to pull out a good plant to make room for a great one. And what's really important here is that this isn't a choice between a good stock and a bad one. Let's say you own stock A. It's a solid company, you expect it to return 10% a year. But then you stumble upon stock B. It's an even better business, similar risk, but you project it can return 20% a year. Well, if you don't have any spare cash, selling A to buy B isn't failure. It's the absolute essence of intelligent capital allocation. All right, and the third principle is for when things just get, well, a little crazy. This is when one of your trees grows so tall it's about to hit the power lines. The market has become euphoric, and the stock price has just been bid up to a level that is completely disconnected from reality. It's time to get out the shears and prune that tree. Here's a super simple way to think about it. Imagine you own a little lemonade stand and it makes a respectable $10,000 a year. One day, some wild billionaire comes up and offers you $10 million for it. Even if you love that lemonade stand, the only rational move is to sell. Why? Because it would take 1,000 years of work to make that much money. When the market makes you an offer that's priced for perfection for centuries to come, you take it. So we know why to sell, but what happens when we refuse? This is where many investors get trapped, confusing long-term holding with holding on for dear life. And honestly, that mistake can be a form of financial suicide. This might be the most important metaphor of this entire explainer. Clinging to a losing investment is like a supermarket manager refusing to throw out a rotten banana. They think, well, if I don't throw it out, I haven't officially lost money on it. But the real, much bigger loss isn't the cost of that banana. It's the valuable prime shelf space that could be holding something people actually want to buy. Your investment capital is that shelf space. Okay, let's talk about the brutal math for a second. Imagine a stock you own gets crushed. It drops 50%. You are now deep, deep in the red. Now, a lot of people's gut reaction is, oh, it needs to go up 50% to get my money back. But that is not how percentages work at all. The math of recovery is much, much tougher than you think. That's right. A 50% drop requires a 100% gain just to get back to where you started. Your $100 stock falls to $50. To get back to $100, it has to double. And it gets worse. If it drops 90%, it needs to go up 900%. Stubbornly holding on to huge losers is like trying to climb a cliff with no ropes. Just look at this 10-year scenario. In scenario A, you stubbornly hold your losing stock for a whole decade, and let's say by some miracle it gets back to what you paid. Your final results? A 0% gain. Now look at scenario B. You admit the mistake, you sell at a 50% loss, and you put that remaining 50 grand into the broader market, earning a simple 10% a year. 10 years later, you've got around $130,000. You still made a mistake, but you are in a vastly better place than the person who just held on. So the crucial skill here is telling the difference between a temporary, cyclical pullback and a permanent, structural decline. When Amazon crashed after the dot-com bubble, yeah, the market was in a full-blown panic, but the actual business was getting stronger and stronger. That's when you hold. But when Nokia got blindsided by the iPhone, that was a structural shift. Their entire business model was becoming a fossil. That's a classic value trap, and holding on is the worst thing you can do. All right, let's bring all this home and turn it into something you can actually use. The key to all of this is to take emotion completely out of the equation and make your selling decisions based on a clear, logical framework. This right here is the most important takeaway of all. Go back and think about those 3 principles. Notice what's missing? Selling because the price dropped and you freaked out is not on the list. In fact, selling based on fear is the #1 cause of investment losses. Selling based on logic, on the other hand, can be the beginning of your greatest gains. So, the next time you get that itch to hit the sell button, don't just react. I want you to stop, take a breath, and ask yourself these 3 questions. Has the business itself fundamentally broken? Have I found a much, much better place to put this money? Or has the price just become completely absurd? And be honest with yourself. And if the answer to all 3 of those questions is no, then the best action is no action at all. Resist that urge to constantly tinker. Trust the work you did in the first place. Close your computer and get a good night's sleep. That right there is how you truly become a long-term investor.